Hello, everyone. I'm Melory Johnson, 25-year beauty veteran, consultant, and strategist. Welcome back to Pretty Equity, where we tackle the real issues facing beauty founders and investors and bring you the answers from the experts behind the deals. In beauty, most conversations focus on the visible parts of the business, the product, the branding, the marketing. But often, in fact, more often than not in this industry, and I've seen it myself having been here for 2.5 decades already, something else determines whether a company actually succeeds, and that's its leadership. But more specifically, the person sitting in the CEO seat. A great CEO can turn a strong product into a durable business, but the wrong CEO or the wrong leadership structure can derail even the most promising brand. And one nuance that doesn't get talked about enough is the difference between a founder and a CEO. Those two roles often get treated as if they are interchangeable, but they're not. Founders start companies, CEOs run companies. Sometimes the founder grows into that role beautifully. Other times, however, the very qualities that made someone a great founder become the obstacles when that company begins to scale. And in today's beauty environment, particularly with the introduction of MOCRA and increased regulatory oversight, the expectations placed on leadership are changing. The CEO is no longer just responsible for growth. They're responsible for structure, accountability, and risk management. So to help me break it all down, I'm excited to be joined today by Conor Riley, Managing Director at Rand & Co. Holdings and former CEO of Luxie Beauty. Conor has the rare vantage point of having both operated companies himself and also working closely with founders and leadership teams as an investor. Today, we're going to explore something that doesn't get discussed nearly enough in beauty: what actually makes someone a successful CEO and when leadership becomes the biggest risk factor in a company. So, Conor, thank you for being here today. You've had the opportunity to sit on both sides of the table, first as a CEO yourself, and now as an investor working with founders and management teams. So, when you moved into the CEO role, what did you learn about leadership that you might not have fully appreciated beforehand?
Well, I mean, first of all, thank you so much for having me on the show and having me part of the program. This is such a great platform and forum to discuss these things because they don't get talked about enough. So when I became a CEO in beauty, I mean, my background is in finance, so I kind of accidentally became the CEO of a beauty company. I was working with Luxie, didn't know anything about the space, didn't know anything about beauty, and really was helping on the financial and kind of corporate structure components with the founders, and then moved into the CEO seat after the founders left the company for very personal reasons, which kind of left the company the headless monster that it was. And From a leadership perspective, one, I didn't know anything about how to lead, which was a problem, and two, I didn't really know much about beauty strategy. So it was full on from day one, making pretty much every mistake you can make as a CEO, which was very problematic. But I think at the end of the 4 years or so that I was CEO of Luxie, I pretty much learned all of the painful lessons that you can learn. Everything from, you know, hiring personality hires to do really, really heavy lifting, to overtitling and underpaying team members, to which is very common in sort of startups. You get a team, they want to make more money somewhere else, and you say, you know what? I know you've only been out of college for 2 years, but you're our new director of operations. So, congratulations. We're not going to pay you anymore, but you have a nice title to put on your resume. And that's prevalent across the industry. You know, it's especially with smaller brands. So, which is horrible because now you have somebody that's overtitled, that's expected to pull all this weight. They're still not paying their bills the way that they'd like to, and it ultimately becomes detrimental for their own career path and for the company. So there was a lot of different leadership challenges that I faced. And I think at the end, the biggest thing that I learned is that leadership is not glamorous, and without good systems and good compliance, you're lost in the woods. You're
Mm,
only as good as the data that you have, and you have to respond to that. And that is, and we'll get into it a little later, but I think that's a fundamental divide between a founder, a CEO, and ultimately what investors are looking for.
hmm hmm And then, what surprised you most about the realities of running a beauty company? Because you said you came from finance. Now you're
Yeah,
in beauty.
so
So what surprised you
so
most?
you look at it from an outsider, from the industry. This is, from the finance guy hat, you look at it, you say, wow, these margins are great. These retail partners are so big. This is going to be amazing. And it's absolutely heartbreaking. It's so difficult to make a brand that anybody cares about, number one. And then it's so difficult to actually do business with these retail partners. You get distribution, you're required to support it. You've got branding, you've got marketing, you've got the constant buzz of social media. You're touching so many people every day. Things are on trend both ways, good and bad, and it's absolutely heartbreaking. You're putting your life, your soul, your everything into these brands. You live and breathe it, and for what? It's such a hard go. And the brands that are successful, they have an outsized return, which is amazing. And for the brands that are just sort of out there, it's so difficult. It's so hard to put the resources together. And what works in the early days of a brand often is detrimental in the later stages of a brand. And
Mm.
so you're constantly needing to pivot. But that was the real surprise. Like it was very difficult to realize, oh my gosh, this company, which I thought was going to be a relatively easy lift to generate revenue and become something that was hopefully a global brand, actually so difficult, so hard, so many sleepless nights, so much travel, so much everything. It really is a very, very difficult industry to be in. And I think if you don't love beauty, absolutely love it. It's not a place for tourists.
Mm. And it's funny because this is exactly why we're having this conversation. Because a lot of people who are still thinking about stepping into the beauty industry look at it, don't come from beauty. They do come
Right.
from tech or finance or wherever they come from. And the beauty world is its own animal. It's its
Yeah.
own thing. And
Yeah.
all the things that you think you would want for a success, for a success story, for your success is actually all the things you don't want in beauty. People will like, oh, we'll go on TikTok. It'll go viral. Oh, that's the best case scenario. Oh no,
Right.
that can kill you. That can literally take a beauty brand right under because
Right.
there is no way to scale up with, you know what I mean? But we're going to get
And
to that in a second. And talking of scale, what decisions ultimately determine whether, from the experiences you had, whether a beauty brand scales successfully or actually just completely stalls out?
so I think that this is sort of an interesting thing because the reality is scale is tied to working capital. You need to scale methodically, you need to scale correctly. Too fast and you're going to put the company in jeopardy, and you're going to put the company in jeopardy in a very, very sort of death spiral way. So the typical profile is someone gets a little bit of traction, they start growing, they don't have any money to go into production, so they borrow some money and they go into production and they produce whatever they think the forecast is calling for from the retailer, what they think they're anticipating, sort of a 90-day turn or 100-day turn on their ecom. So they buy that much. Okay, cool. They get that in the warehouse and now they have to sell all that so that they can pay people back. They do it. They're feeling pretty good. Uh-oh. Their sales didn't quite materialize in their retail partners. So now there's RTVs there, which means now you have to pay the difference between what they bought and what they returned. Your ecom kind of got oversaturated. The viral thing isn't quite lifting, so now you're spending. Your ROAS on that, hey, we're killing it. It's 7 times return on ad spend, 7 times. That's great. And then it's 5 times. Oh, well, we're still making money. And then it's 4 times. And you're like, your ecom guy is over the moon because they're doing great. But what you don't realize is you're losing money. What you don't realize is between 4 times ROAS, that's great. 25% is your marketing, 20% is your shipping. You've got your COGS, whatever they are, usually pretty low, and then you have your contribution to overhead. So now you're losing money on your ecom business. Your retail business is unsupported, and now you're being asked to support with marketing. You're being asked for trade marketing. There's a great event somewhere in Wichita that you have to go to educate some buyers and do this. You got a small team, and now you've got plane tickets and hotels, and maybe you're going yourself. And so the only way out now is to even do a bigger order with your retail partner, who now you owe money to, and to maybe cut back on spending on your ecom so that that becomes more profitable. But what ends up happening is you're doubling down on your retail partner. Now they have a second run of your product and it's not moving. So now you have more RTVs there. You're not spending on your ecom, so the top line numbers are dipping. And now you just get crushed in the middle. You can't support yourself, and you owe everybody money. Your manufacturer who's saying, "Hey, look, we're going to give you terms," is suddenly saying, "Hey, we're going to call in all of this, and you got to pay us," and now you're stuck. And so that's why when you're scaling, you have to say, "Okay, retailer, we're going to only go into this many doors, and once we see some success there, then we're going to go into this many doors." Your ecom business has to truly be viral. Okay, we're not going to order any more inventory until we sell out of this. We're not going to anticipate that we're going to be able to support this until we really see this sort of overall lift in our numbers. And typically the methodical approach to business feels like you're giving up top line revenue and feels like if we only had a little bit more money to buy more product, then we could scale to, this higher ground that no one ever achieves. But the reality is you actually are closer to the growth that you think, and you don't need as much money as you think, and you're not going to make as much money as you think. And those are the hard realities.
No, absolutely. And then again, you're talking about reaching out to your CM, your contract manufacturer, and and now with Mokra in place, and we can talk about this in a bit too, but I just want to say something here. You know, with Mokra in place and the expectations on CGMP,
Mm-hmm.
that are placed on these companies by the FDA now, you know, there there's no such thing as easy scale up anymore. Number one, are they able to? Do they have the capacity to be able
Right.
to do a 3 times, 5 times scale up with you? Because maybe they don't, which
Yeah.
then means you now got to find a second contract manufacturer, right?
Yeah.
And you know what that takes. If you find a second manufacturer, you now have to start from scratch because you're going to have to put everything back through R&D. It's a tech transfer. And not
Mm-hmm.
every manufacturer can do tech transfer as well, right? So you got to go through that, and that takes time. You got to go through all your stability testing, at least, right?
Mm-hmm.
Your stability, your microbial testing, all of that. If you have an OTC, a sunscreen, it's at least 6 months. You know what I
Yep.
mean? Everything else, it's at least 3 months. There's nothing fast about or easy about scaling up.
Right.
And then you have to make sure what's happening with my suppliers because your raw materials, are they still available? Have they changed raw materials? Are you selling in California or New York, right? And there's a new regulation that's in the
Right.
pipelines saying that, this ingredient and that ingredient are no longer
Right.
acceptable, right? On
Right.
their, on an inky list. So on an ingredient list. So, you know what I mean? So have those got to be removed and replaced? And if that's the case, what is that going to take you in terms of there's
Yeah.
I don't think people realize like how complicated it is to be
Yeah.
in the beauty industry.
Well, and also I don't think people realize how, when you're starting, I mean, to kind of go the other way, when you're starting, you have an idea for a formulation. You don't have any money. MOQs, what MOQs? We need 10 of these. So you're talking to the local supplier, the local chemist, the local people down the street that'll do this. You're kind of cobbling something together. It works. You're selling to friends and family. They love it. Everyone's saying you should go. You should do this online. You should really sell this. And then you kind of get that first 100 units in the garage and can sell out of them. And often there's sort of a lot of fast scaling businesses in the early days. And you're not concerned with any of this because you exist out sort of outside of the regulatory environment. You're barely even a real business. You don't have anything trademarked. You're using kind of off the shelf componentry, whatever you can get. And your margins aren't as good as they will be at scale, but you're making money. And so I think it's really unfortunate that CEOs and founders in the early days have to sort of adopt such a steep learning curve because now you're going from let me learn about formulation at scale and shelf stability to no chemicals and regulatory environments in each state, new federal regulatory environments, and you're often relying on product development people to kind of help lead the way there. You're often relying on contract manufacturers to give you inputs on what's trending, but it's so difficult for a CEO or founder who has a great idea to kind of be in a place where now they have to, have that Deloitte McKinsey project management hat and actually manage through, a multitude of lawyers and accountants and supply chain people and all of these. And at the end of the day, they're like, wait a second, do I own my formulas or do I not own my formulas? Like it's so convoluted. And so I think that it's a very difficult path forward, but it's not until you hit sort of a real business scalability that you run into those walls. So
Mm,
I think that there's a bit of a disconnect between how important the regulatory environment is and what some of these founders have in their lived experience.
mm,
Because you say, hey, there's these new laws, and they're like, we don't care. We've been scaled. Like, I got my product in Nordstrom. We're selling online. We're killing it. What do you mean? And then the scary thing is between the contract manufacturers that are trying to adopt these regulations, the founders that are trying to scale quickly, there's sort of a conversation of how do we minimize or sort of disallow these from hitting our business. And I think that that's tricky because what that often does is just kick the can down the road where you're not sort of installing a regulatory framework in these businesses. And instead, you're sort of relying on here's the third party audit that the contract manufacturer got, here's the this, the that, and you end up sort of coordinating paperwork more than compliance.
mm,
So
mm.
it's,
Yeah.
I think scalability is definitely like really an interesting thing because you don't hit that scalability until you're on the other side of the sort of regulatory and compliance hurdle. And crossing that Rubicon can be very, very difficult.
Mm.
Most founders are just not equipped to do it.
No, and I mean they're not equipped to do it because most of them they don't even know what they don't know.
Right.
And it's not even that they don't know what they don't know. They don't know that they don't know. Do you know what I'm
Right.
saying? Like you say, they come from tech or finance, and they look at the beauty industry and they're like, wow. You know what I mean? Like,
Right.
look how much money there is in this industry. And like you say, I mean, you look at how much it could cost you to, you manufacture this or they find someone who's manufacturing in their garage, like you say,
Right.
in small batches. And don't even get me started on that because that is
Yeah.
a regulatory nightmare right there. And a conversation for another day. But
Right.
what I do.
Or you have it's also very, very difficult. I mean, and this is sort of the investor hat on, where you have like if they come from tech, if they come from outside the industry, okay, they're business people. If they come from TV or they're a celebrity or they're a celebrity makeup artist, now you're dealing with people that are like have such a wildly different lived experience. They're looking just for efficacy and they could care less about what any of the regulations mean. So you're sitting there saying, well, we can't invest in this because you need to have the regulatory piece. And then they bring out the best kind of compliance manager sourcing person. And then they do everything so to the nth degree that now your cogs are just insane. And you say, okay, we can't run this business this way. It's just not going to work. And the reference points are, other beauty brands that seem to be doing well, but it's still, it's not, that's not a real proof point, because it's like,
No, and
if
you
you're
also don't know
making
what goes
X
on
for
behind
Y,
closed doors, Connor.
yeah, exactly,
You know.
exactly.
But let's, continue down our leadership
Yeah.
conversation here because, one thing that often becomes clear, as I've seen companies grow, is that leadership challenges start to surface in ways exactly like what we've been alluding to that weren't necessarily visible in the company's early days, right?
Mhm.
Which brings us to the important distinction. In beauty, especially, we often see founders automatically assume the title of CEO. But founding a company and running one are not necessarily the same skill set.
Right.
Founders are often driven by vision, creativity, a deep belief in this thing that they've created in their product. But scaling a company requires operational discipline, governance, and really the ability to make difficult strategic decisions. So, Connor, from your perspective, how do you think about the difference between a founder and a CEO?
Yeah, I think that the real truth of that is a founder is such a amazing person. It's lightning in a bottle, it's vision, it's growth, it's a deep, deep understanding of the product and the consumer. And a CEO is essentially an administrator. They're an administrator of the business. They have a vision for growth. They have a mandate set by the board, but fundamentally their role is to administer the business in a sensible fashion. And
Mhm.
so it's a very weird kind of dynamic, because most people hear the term CEO and think that's the ultimate decision maker. That's the guy or gal. That's the person that's running this whole thing. And it's like, okay, that's true in some sense, but the reality is the CEO, as the administrator, really relies on a founder vision and a board vision to steer the company to some kind of a goal.
Mhm.
Now, the meaning of a role of like a CEO is much more meaningful in a larger business. So if you have a business with 5 people in it and one of them is the CEO, doesn't really mean much. But if there's 100 people in the business, the CEO has direct reports. It's sort of a managerial thing. It really becomes true administering the business. And the disconnect that we see in what I think the question is really driving at is the vision from a founder is so important as the catalyst for the business to even start. You need that vision. The vision and the goals that the founder set get the brand into retail, give people confidence. The connection that they have with their customers is derived because they're authentically and validly connecting to those customers, especially like in beauty, right? You're not going to put something on your face that the world is going to see unless you're confident that it's going to do something for you. And you need the information from the founder to tell you what it is that you're getting. So what happens is the founders are the sort of impetus for the business to start and the catalyst for the early stage growth. And then the business gets to a place where it gets really hard to manage without sort of someone stepping into that administrator role. And now the founder feels like things are being taken away from them. They feel like I it's important for me to maintain the company culture, so I want to do every interview for staffing. And it's like, you make bad staffing decisions. I can speak from that because I make bad staffing decisions. If I connect with someone on anything, I'm like, they should really work for me. And it was awful because I often hired people with good intentions that were just not qualified at their job. And it was just because I like having conversations with people, and it was difficult to understand, the HR methodologies that any HR manager would be able to implement. So, you know, I think that the when there's that tipping point where the business has scaled to a place where now you have sort of a management team, you have sort of middle management, you have a group that's going out there in their different departments. That's when you really want to have a CEO that can be a good administrator, and that's where founders start falling down.
Mm-mm.
And
So,
usually it's around that time that they also realize they need outside capital to grow.
hmm hmm. Okay, so I want to dig into this a little bit more.
Yeah.
So what capabilities distinguish someone who is great at starting a company from someone who is equipped to run and scale one? So I know we
Yeah.
touched on this, but for the audience who are watching, who are founders in the audience, I kind of want to I want them to kind of get the sense of, okay, I'm the founder, I understand my role, but am I actually equipped to run and scale?
Yeah. And let's also break this down that founders can run and scale businesses.
Mhm.
And founders are amazing and are gonna continue to be the key driving force of the business. And really, when you look at like the specifics of what the differences are, so if you're a founder, the vision, that's all you, the products, the positioning in the marketplace, and being sort of the truth teller in the business to say, we're positioning well, this is a good outlet for us, this is where we need to go. Or just being honest about it and saying, you know what, I being in this discount retailer and having as much sell through as we have is bad for the brand. This is not my vision. This is not where I want to go. We need to clean up our channel partners so that we can build a brand that's going to last forever. So the founder is very clear on where the market fits in the broader spectrum of beauty, the vision of the products and the brand, and the overall kind of story of the brand. Which, if you're going to tell a brand story, products are what tell that story. So you have to be able to say, this is who we are, and the proof is in the pudding. Here's the products that sort of illustrate that. So that the founder vision is really what drives the company. And then when it comes to skill set of really maintaining that growth, understanding what are the management tools that you're going to implement into that. And management tools are very similar to diets. It doesn't matter which one you lean into, but you got to pick one. You can't just be out there doing anything. There's discipline, there's KPIs. How do you manage your team? And it, it's something that has been kind of discussed since the beginning of time. And there's great management tools out there. There's great books that have been written. There's so many different theories on this subject. It makes sense. I would encourage every founder to just hit the pause button and pick up a book regarding management. There's great high output management, which is an amazing book written by I think Andrew Grove, the CEO of Intel, wrote this book like back in the 80s, and it's a great book on management and just getting the most out of your team. So as the business gets more advanced, I'd say the founder perspective needs to be, let me get an administrator here that can run this business so that I can focus on the vision and growth. And that's really, I think, the key differentiator in terms of roles is, if you're a founder and you're listening to this, first of all, congratulations. Secondly, realize the vision has real value. People minimize vision because they feel like, you know, I need to get this product sold. I need to get the contract manufacturer in. We have this vendor agreement that needs to get done. I don't know how UPC codes work. Like, the vision is what separates your brand from the noise. And that's an important thing to keep kind of to keep front and center in your mind. And all this other stuff is kind of administrative tasks.
Mm.
So if you want to be an investable founder, hold on to your vision, realize that the founder's role is to drive the company forward, and that the CEO or professional CEO role is to administrate the company, implement a management style, and keep the team moving.
Okay. So, I mean, yes, and we're gonna talk a bit more about that in a bit too.
Yeah.
But, just staying on the topic of CEO v founder, there are definitely times when founders run into difficulty letting go of their CEO title as the business grows. And, have you come across, some common difficulties that they that, this type of founder shares?
Yeah, I think that, you know, the emotional connection that founders have to their brand is quite profound. And I think that the common sense of it is that they're getting cut out in some way.
Mm,
And unfortunately, that is a bit true. You know, when a CEO comes in and will start managing the business, it's really important that the founder is aware and kind of moving downfield. I think that a board position and kind of an executive directorship is a great place for a founder. I would stay away from chief creative officer or those kind of funky titles that
mm,
I think are more PR driven than anything else. But if you're a real founder and have built a company from the ground up, I think being a chair of the board, or at least on the board, makes sense. You want a platform where you can keep sharing and pushing your vision. And I think that the hardest thing is just giving up, or that feeling that you're giving up and getting pushed aside.
mm,
And there's nothing anyone can say when you're talking about the roles and titles and this that seems to land with the founder, um, because it just is so visceral. It's such
mm,
a
mm,
it's like a non-thinking thing. So the common thread is I feel like I'm getting pushed out of my own company. I want to maintain this role or this title, even if someone else is going to be in this position. And then the difficulty is often they don't see really where they add value.
mm. I,
And
I I think as well, it's just exactly why you and I are having this conversation. I think as well, there's a disconnect between understanding, who you are as the founder versus the person you hired to be your CEO.
right,
You know what I mean? So this is the part that I want to drive home because,
yeah,
and I asked you that question because the challenge I've encountered over the years with brands I've worked with is exactly what you said, this intense emotional attachment some founders have to what they've created,
right.
and rightfully so. You know what I mean?
Well, and
And
let's just speak to a second of like how that really manifests itself in the negative ways. So when a founder maintains their position as CEO, what you see is overspending on marketing, commitment to products that are the over skewing a brand, and commitments to products that never come to market.
mm,
So the founder, because of their lens on the business, they typically are confused top line revenue with profitability.
mm,
They are not concerned about margin as much as people that are looking at financial data. And so what happens is, and this is how brands die. And this is where the good stuff that they were doing early kind of crashes and burns later. So robbing Peter to pay Paul, when you're an up and coming brand, great, go for it. You need to get to scale. You need to start getting that toehold in retail. But once you get to scale and kind of all of that catches up to
mm,
you, that's when you need to have an administrative team. And so what happens, what these founders do is, because of how they're looking at the world, it's they overspend on marketing, they overspend on products, they buy too much and overly rely on the contract manufacturers. And
100%. They
yeah,
become obstacles to their own company's
right,
growth.
right. And so then what happens is the founders feel trapped, and they start feeling like nothing I do is right. And I think that's where I would encourage founders to take a deep breath. If they have capital partners that are already in the business, to go to them and say, listen, we need to put the solution is guardrails. You say,
Mm,
I need guardrails. I want to develop these products. What's our margin? We need to have a set margin across all of our products so that we know what's going on. Marketing, can we have the board approve the marketing budget? I have some great marketing ideas. I really want to grow the brand. I love the brand. I need the board to mandate what our marketing budget is, and I need to have categories. And if I want to spend more than 25,000 or $50,000 on an activation, the board needs to approve it. And what that does is it empowers the board to put some guardrails in place, and it gives that founder the backup of saying, "Hey, if this doesn't go well, we all decided that these margins were where we were.
Mm.
If this doesn't land the way that we were hoping it would, you guys approved this $50,000 spend. I'm not out here operating in the woods. We're all trying to make the best decision possible. Guardrails help the founder, and having a good board with industry pros can really go a long way in giving a framework for the founder to operate in. And is
Mm.
a nice kind of adjustment period where the founder can say, as we have more and more guardrails, it makes it easier and easier to have a CEO be the administrator of these. And the founder can then really focus on the vision and really focus on giving the board the feedback that it needs so that it can better manage the marketing budget. It can better manage the product fit. And, you know, I just think that's the right tool for founders when they get kind of stuck.
No, exactly. And to your point earlier, having, a role on the board, executive chairman, chairman of the board, whatever that role is for the founder on the board is honestly, I agree with you, the best place to put a founder because I've just seen it so many times where there's just such a confusion between a CEO's role and a founder's role, and you know what I mean? And then there's a complete misalignment. And
Right,
when they're at least, if you've got a founder on the board, they're part of the decision-making process. This is
yep,
their company. This is
yep,
their, do you know what I'm saying? And I don't want founders to ever feel like they need to give up their company in order for their company to succeed. But they also need to know when to step aside, not away, but aside. Do you know what I'm saying? And
right,
trust, the people that they've hired, like their CEO. You know what I mean? You hired
right,
this person. This is your person. You decide. So trust that person. Why put someone in that place that you don't trust? Right?
right.
So trust that person to do the job. So
And
so let's talk a bit about what success looks like, with respect to founders, because let's dig into a bit about successful founders, and how do they manage that transition from creator to leader? Is it purely in a board role? Is it by trusting their CEO? But they are still a leader within the company. So this creator now is transitioning to leader. So let's talk about what a successful founder looks like.
yeah, I think it's good to kind of set that up because I think the founder goes from founder to, kind of passing the baton to a more seasoned business administrator person that can step into that CEO seat to shareholder and value driver for the company. And I think that founders often don't understand the power and value of their equity position. So founders, as they are taking on more capital, will sell parts of their company or agree to different covenants so that parts of their business are maintained to certain standards. So if you borrow money or you take equity dollars, you're responsible to those shareholders. And a lot of times the founder is so focused on keeping the company cash flowing so that they get some kind of a salary, and founders often will be the last ones to take a salary because they need to support their team. So there's very much a living hand to mouth that happens in the early stage of a business. So success for them often is framed by being cash flow positive enough so that I can pay my bills. And if you talk to any founder, as much as they want to have this giant company, a lot of them are like, hey, I just got to get paid. And the number of founders that are taking outside consultant work just to make the ends meet is massive. So I think what you want to do is first and foremost be the visionary and stabilize the company, get that cash flow in, build the company to scale. Now transition out to a board position, have a CEO come in, and now really lean into the power of that equity. You're still a significant shareholder in the company. You still can vote those shares. Depending on the bylaws of the company, you're mandated to have shareholder votes when certain material things change. So as much as there might be a conflict between founder and CEO, CEO may have, with incentives and everything, 4 to 8% of the company. The founder typically will hold on to 20, 30, 40, sometimes even 50% of the company as it goes through taking on these different capital rounds.
Mm,
So you could be in a position where you're no longer the CEO and you have a board seat, but you, in effect, because of your equity position, control everything that goes on in the company. So success becomes, let me be a savvy visionary, let me be a savvy business person, to let me be a shareholder and let me drive shareholder value. And that's really the end game. And
mm.
when you sell your business for hundreds of millions of dollars, that's what puts that money in your pocket. So I would say that the long term here is titles don't matter as much as preserving your equity, and advocating for shareholder value is something that everybody wants to do.
If you were an investor, right, what would signal to you that this founder, right, this founder slash CEO, may not actually want to be or may not actually be suited to be the company's long-term CEO? Because at some point, I'm sure the board is going to look at this and say, you know what, this is working now, but I'm not sure this is working in the long term. And what are those signals? Where are the
I,
flags?
I think I think the biggest thing is that a lot of founders are not comfortable with stability because that's just not what they're from. So a lot of founders are always looking to drive change. And when you have a founder that's saying, you know, we have this amazing skincare thing, but we want to pivot into an FDA approved clinical situation, and I'm going to start talking to dermatologists, and you're like, whoa, 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 you're pivoting out of the business that we just got into. What is that? Or we're gonna move from color to hair care, or we're gonna do, just big category jump, some kind of change. And when you start seeing that, you realize like this person is ideating all day. They have a vision for everything that this brand can do, and in their version, it can do anything. Hey, we got a successful color cosmetics. Why
Mm,
not do a clothing line?
mm,
You know,
mm,
it that's when you kind of say, okay, the hamster brain, which I'm using in the most, complimentary way possible, that hamster brain is moving too fast for a business to have stable growth. And
mm,
so when you are looking as an investor or as a board person, if they're really sort of embedded within the fabric of the current product offering, if they see a long, slow growth and they get excited about where things are going in the, whether it's skincare or hair care or color or whatever it is, if they're just in that groove, kind of in the pocket, then you're like, all right, they're going to go the distance. But if they're all over the map, looking for change, wanting to do something, and you saw this, I think the most recent example of this is the live selling on TikTok. The so many CEOs that seem to be kind of in a very successful place. The second the live selling started, they were saying, I'm going to go on camera. I'm going to live sell this. I'm the product expert. I'm going to build this studio. We're going to do this. We're going to do that. And it as an investor, you're like, whoa, we're putting capex into something. You're the new brand face. How does this tie into our marketing? Can we even do this? Well, just on the promise of super success. So what you're looking for is a founder that's methodical, that's slow. And this is the other thing is typically it's the second or third time around for them.
yeah.
It's great when a founder has had some experience and understands, okay, we're this is just a skincare brand. This is my skincare brand. This is the growth. And
Mm,
and it's smooth, slow, and steady. That's great. And if they start wanting to be all things to all people and too opportunistic and just moving too fast, then it's not a fit. And
yeah.
that's when you say you've got a great vision. And so we are going to have you on the board as a visionary, and we're just going to net the things that work for the company, and you're free to do other stuff do that clothing line. Don't make it this, make it yours, So,
Yeah, I mean, but I found so many first-time founders who are that they're almost it's almost ADHD. You know what I'm saying?
right,
It's like, oh well, if I'm doing this, then I can do perfume too, and if I'm doing perfume, then I can get into the lifestyle, and if I'm
right,
doing lifestyle, then I can what I mean. And then it's like you're scratching your head. Can we come back to
right,
our first conversation? Can we just
right,
start? Can we
right.
just start here?
I mean, I can't tell you how many founders present their brand as a lifestyle prestige brand. And you're
Oh, I
like,
know.
but and then channel management becomes an issue. Monday morning quarterbacking becomes an issue. I mean, I think that's, and I don't know how real this is, but I think a lot of founders kind of go off script when they become the last sort of bottleneck on anything. So you have a company that's trying to scale, they're in the CEO seat, and their, field team comes back and says, hey, we have an opportunity to roll out here, roll out there, and founders have, I've never seen so many people emotionally vested in whether it's Sephora or Ulta. Is it Sephora? Is it Ulta? Do we do this? Do we do that? Is it exclusive? Is it not exclusive? Where in the store are we on the prestige side or are we on the mass side? And it's like the founder that's sitting there saying we're a masstige brand, but like, all right, man, pick a lane. I don't know. What do you want to do? It's
Yeah,
crazy.
well, I mean,
Like,
we also need to know, right? So if you pick
right,
your lane, we need we
right.
need to know where we sit, right?
Right, right. Or
Um,
people that are like, we believe that we can meet our customer where they are. We're going to do this Target thing. We hope that they're interested, and we're selling $600 skincare. And you're like, it's going to be a long road in Target, you know?
no, I love
Like,
it. So I mean, I'm sure that there have been situations where bringing in a different CEO ultimately unlocked the company's next stage of growth. I can't imagine, I can't imagine it was a very comfortable conversation to have with with as
yeah.
an investor to have with the
But it
CEO,
but it
but
typically comes with investment. So when you're sitting there and you're having that conversation with the CEO, you're saying, listen, what you've built is great. That's why we're writing a check into this ecosystem. We're going to have new financial safeguards. We're going to have a new reporting infrastructure. We're going to have new help in doing your monthly close, quarterly close. We're going to have 13-week cash flow forecasts. We're going to have all of these financial goodies that are going to help optimize the business. And we just need to put someone in the driver's seat who knows how to push those buttons so that they can be better at optimizing the business and ultimately better at reporting to the board. So it's sort of like saying to a founder, like, you've been flying a small airplane with like a stick and rudder, and now we're going to build a turbojet. And this jet, little complicated for you to fly. So you're going to be the navigator now. And they feel like, well, I don't get to fly the plane. And it's like, takes two, three people to fly this plane, but you're the now you still get to say where we're going. We're all going to listen to you. So I think when it's framed properly and the founder sitting there and realizing like, yeah, I don't want to be the one who's reviewing, you know, cash flow forecast, that's reviewing financial models, that's sitting down with my CFO and building out week over week budgets, that's going to have performance evaluations based on KPIs that get set to deliver against larger KPIs that when the CEO realizes that there's a board that they have to answer to and they're no longer the boss, most founders don't like that. Most founders want to be the reason why they want to be the CEO is they want to be the ultimate decision maker. And if you're like, the CEO just answers to the board. So whether it's you or someone else, you got to answer to the board. Here's your homework. They're like, oh shit, I don't want, like, how can, because like there's a lot of sort of dirty corners of the house that most founders don't pay attention to that are just sort of the standard for more seasoned executives. And so when it's framed of like, we're going to be checking every corner every week, they're like, I need to be in a different place so I can add value. And so I'd say it's a very positive conversation with founders when it's framed properly. and when they understand the value. And I would tell investors out there that if you have a founder and you want to do more for the business, but they're being resistant, you just haven't framed that conversation right.
Yeah. Yeah. So I want to pivot here a little bit and talk about governance and decision making.
Mm-hmm.
Because another area that often shapes how a CEO operates is governance, right?
Mm-hmm.
Specifically, how decision making works between the founder, the leadership team, and the board. And as companies grow, the leadership structure inevitably becomes more complicated, right? And so, with
Mm-hmm.
that said, and since you've worn both an investor and a CEO CEO hat,
Mm-hmm.
how should decision making actually work between the founder, the CEO, and the board as the company scales?
Yeah. So I think that this is a really kind of complicated concept in real life, but the solution is actually very simple. So it's all about communication, and it's all about defining people's roles in a clear way. So the founder, visionary, tip of the spear, the one that's seeing the trends before things are happening, they might have input, valuable input on where the company needs to go. They need to talk to their board about how they see the company growing and 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 sync with their board on some kind of, is it every year? Is it every 6 months? Is it every quarter? Where their input is heard by the board and the board's plan is adjusted to the company. Now, practically speaking, that should be an annual thing because 3 months is just not enough time. There's so many things that come and go. 6 months may work, but it's still easy to kind of get sidetracked. What you're really looking at is the founder briefs the board on where they see the brand and company needing to go. The board builds out a plan. That plan involves a budget and a forecast and all the stuff that is needed, which is another reason why you don't want to do it every quarter and it might be hard to do every 6 months. Because if the founder says, we need to open new international markets. I'm seeing a lot of demand for us in Europe, and Douglas is calling, and we need to take advantage of these opportunities. Okay, cool. Great. The board's position is to execute against what the founder wants. They might be the majority shareholder or a significant shareholder. So the board goes to work. They get the finance team building out a budget. Now the board needs to have consensus on whether or not that's an agreed upon plan. So it goes from the founder to the board. The board builds out what they need. Now the board has a plan. So
Mhm.
now the board's plan is, here's where the growth of the business is coming into effect. Here's our budget. Here's our forecast. Here's all the things that we are going to decide to do for this year. Now that gets passed to the CEO, and now the CEO has to make a lot of decisions on how to implement that plan. And there needs to be clear boundaries between what is such a large change to that plan that it requires board approval or board oversight, and what's kind of the minutia of that plan that would not require anything and that the CEO can do on his own.
Mm-mm.
But
And I'm
it's
sure,
that
sorry, go ahead.
that's the waterfall though. So it's like you have the tip of the spear, the visionary that's allowed to give valuable input on where things are going, and that can be product, that can be new launches, that can be gaps in the product assortment that need to be filled. There's so much that the founder brings to the table. Once the board is briefed, they take that insight, they build a plan. Once the plan, budget, and everything is done, it's presented to the CEO, who's mandated to adopt it. It's not presented to the CEO for approval. It's presented to the CEO of like, all right, this is your job for the year. And then the CEO goes and has clear guidelines into what they can do and what they can't do. And that's, you know, I'm repeating it because it's so important that
Mm.
whatever you fit, whether you're a board member or a founder or a CEO, it's really important that you got to say, we need a chain of command. We need to make sure everyone has their input and that's where it goes. You don't want the CEO to be leading the board that then is informing the founder. Because if you do it the backwards way, Now the board feels we got to rush. We need to make sure the CEO has what they need because they're having problems. The founder's saying, well, wait, the CEO is having problems because they're not doing what I said. It becomes real messy.
Well, that's exactly where I've seen friction emerge, like in within that
Yeah,
relationship, is
yeah.
exactly what you just described. But so my question to you now has to do with Mokra, because how much, talking of friction, when friction does arise, how much do you think Mokra has to play in the misalignment when, this relationship kind of starts going sideways? Do you think Mokra, and the new regulations have a role to play in that?
I think yes. Well, and I'll tell you why. So, and this is what I've seen, right? The regulatory environment in beauty is constantly changing, and Mocha was a big sea change. And it's so far reaching, and the implementation of it was kind of weird or messy, where a lot of start stops at the beginning. And even now, some people are more educated than others. So, what I see is a knowledge gap between the founders that are looking at vision, the CEOs that are working a little closer with their suppliers, and the board that are like, we don't want to get sued. There's lawyers that are chasing around for gaps of compliance. We saw that with the ADA website issues during the pandemic. We see it with what is that 65 chemicals in California where
Mm-hmm.
and
Prop
lawyers are
65.
going to lawyer, right?
Mm-hmm.
So
Mm-hmm.
you have a board that becomes very conservative. You have a CEO that's a little bit further along on the MOCRA ramifications, and then you have a founder that feels like they're just getting told no. And so what you have is you have kind of, if there's a misalignment between the CEO and founder and board, MOCRA becomes a huge tool to move one person's agenda along farther than the other. So the solve there is, first of all, de-escalate the situation. Just a regulatory thing, no big deal. Let's get someone to come in, brief the board, and the founder and the CEO, just everyone saying, this is MOCRA as we see it, because everyone sees it differently. How do we see it? This is how we see it. Have that set at the board level. So now the CEO's job is to be the administrator, and the founder's job is to be the visionary, and the board's job is to make sure they don't get sued. But everyone has a singular version of what MOCRA means to that organization, and the friction gets de-escalated because in the event that because poor CEO, right? They're trying to make decisions. They're trying to make it right. You got your founder who hasn't been actively involved in the business part of the business for like 2 years coming in with these wild ideas of new product. And they're like, oh my God, I'm trying to deliver a profitable business to the board. I'm trying to make your shares actually worth something. And you're telling me I got to go this way. And I'm saying this is out of compliance and I'm the bad guy. Like
Yeah. And at the
that's
same time, you're trying to keep the FDA out of your
right.
doors.
Right, exactly. So what you got to do, the board needs to define what MOCRA means for that company, what their process is, what they're going to do, what the reporting structure is. The CEO needs to be looking at things from a budget and kind of operational vision. The founder needs to make sure that their input is heard by the board and they've been briefed on MOCRA. So they're gonna modify their vision saying, okay, I have a vision for this. I know my board is saying MOCRA is this. Okay, I can make this work. And it's not perfect, but at least you centralize the knowledge base of MOCRA so it doesn't become a bargaining chip for one person or another. I mean, I've also seen it where the founder knows more, is a beauty person. They know more about MOCRA, and they're like, this CEO is gonna kill the brand because they don't know anything about this. This whole supply chain, next year's plans, everything you've got going has to be thrown out. I think we should fire them, and I should step back in as CEO because I understand the regulatory environment. And you're like, whoa, what?
Yeah,
What?
no, no, no.
Just take it into a neutral place, have that framework be agreed upon, and less waves, the better,
Hmm.
you
Hmm.
know?
So, so I want to talk a little bit more about strategic paths, right?
Mm-hmm.
Because so Here's what I'm thinking. So, how important is it for leadership and investors to be aligned early on about the company's real strategic path? What I mean is, like, where are you going? Are you building a long-term operating company? Are you positioning for acquisition? You know what I mean? Are you building toward a transaction? All
Yeah,
of these things, in my experience, need to be aligned early on, right? And
absolutely.
everybody needs to be on the same page. So I don't know if you want to react to that.
Yeah, absolutely. I mean, I think that you need to, if you're a founder, and you're looking at bringing on capital, talking to them about how they manage their capital, how they manage their fund, what they're looking for is crucial because when that capital comes in, that is going to set the stage for all of the strategic growth. So if you are working with a venture fund that says we have a 10-year horizon, we look for big multiples on our capital, we want you to grow and focus solely on growth. We're going to back you to the hilt, but you know, we have about 3 years of backing you, and then we have 10 years before we got to get our money out. You're like, all right, okay, so if I'm making losses but growing top line, you got me? Yeah, okay. That's one path. And a lot of VCs that like kind of the hype around a celebrity brand or are looking for sort of this outsized return will fund losses to grab the distribution, make it a household name, and build brand value that way. All right, that's their thing. Private equity groups, nah, not looking for losses. They want EBITDA, they want multiples. They're looking for brand value that will add to that multiplier. So they're going to say, if you can creep up your EBITDA from 10 to 15% to like 20, 25%, we are going to love that. Okay. Cash flow is more important. That singular check at the beginning, that's their entry point, and they need to be out 5 years later. So they're going to expect you to start getting the company prepared for a sale in 3 to 4 years, which sounds like a long time, but you're like, in 36 months, we're going to have to sell this thing? What's going to happen to me? Now, maybe that's a good thing. Private
Yeah, now
equity
you
guys
now
are
you can
super
move on to your
smart.
clothing line.
Yeah. Yeah. I mean, it's not that bad. And then you have other guys like family offices. There's a lot of family offices out there. They they may be looking for cash flow and a sale, but have a very long timeline and have a very flexible capital structure. So that's where if you're a founder, it's really important to know what do they want with this money and to make sure you're okay with that. If you are a founder and you're looking at creating stability, a fast growing venture backed beauty brand may not be the right way to kind of create that stability. And if you're 3 years of operating losses and you don't hit your goal and that venture fund pulls back, which we saw with a lot of, um, we've seen that a lot with all kinds of different brands in such a fragmented market. When they pull back, now you can't go anywhere. You're like, we had losses for 3 years, and people are like, well, you don't have a multiplier, so good luck servicing your broad retail base. It's like it's really it's really important to understand the capital and the strategic vision.
Mm-hmm.
And once you get an understanding of that, then you can sit back and say, okay, how does the board impact the strategic vision? How do we kind of report into that? Where does the growth come to support that? But you absolutely, as a founder, you need to have your own vision too. That's really helpful. If you're a founder and you're working on a beauty brand, ask yourself, do I want to sell this in 10 years? If this
Yeah.
business made $1 million a year that I could put in my pocket, would I be happy just keeping that as like an annuity for the rest of my life? Like, what is the long term?
No, absolutely. I mean, look, the other thing where I've seen, just pressure, a lot of pressure on founders is that, they do come as creators. I mean, a lot of them are, they're more creators than they are finance people, right? So they
Yes.
come with these visions, they come with these creations, their products, and they have these great ideas, right? And I mean, everything has to start at the idea, right? Without the idea,
Mhm.
you got nothing. But they don't have capital and they don't have a way of funding what they want to do. So they take money from wherever they can find it, right?
Right.
And they either whittle themselves down to nothing in terms of equity, or they have so much pressure coming from an investor to do exactly what the investor is expecting in exchange for that money that I just see you know, you know, so much pressure on founders to, and I feel like if there was a way for them, we could help them find the right investor. When do you take money? When do you say no? I need a hold for now. You know what I mean? Like, when is that point where I know how excited you are about getting your product onto the market, right? And I know how
Yep.
excited you are about your vision, but taking money from anywhere and sometimes from investors who may not come from the beauty industry, who have no idea how beauty works. They can
Right.
put expectations on you that you may not be able to handle. You know what I mean? Like I don't
Yeah.
know, if you have any thoughts
No, it's
on
I mean
on that.
it's a massive issue because like you said, founders want to create and they're typically pretty cool people. I mean, founders are so unique and so in this world of creation and ideation and my friend so and so was at such and such and I think South by Southwest, which is going on right now, everybody's there. There's going to be a whole 10 new brands when that week is over. They need to the advice that I would give to founders is think of your capital stack. Think of a capital event as a first in a series of dominoes and try to understand where the pressure is going to come from and try to understand what the expectations are of the investor. So, investors, when they write a check, they expect a return. And that return can come in a lot of different ways, but that return is expected. And they may be the most understanding people in the universe, but they are not doing this for charity. And so, if you take any money you are agreeing to pay that person back plus interest. You are agreeing to manage the company in a way where they're gonna get some upside. That's what they're doing. So I think that the biggest issue that I see is a misalignment between founders and investors. And in the early days, what that looks like is an investor who's not really an investor. They just made some money at Apple or Meta or here or there and are sort of a retired executive that's writing small checks. They take a small check from a small investor, and now that investor is like, hey, it's been 6 months. I need that money back. The founder doesn't have much in a business, and so there's a lot of pressure there, and so you get on this sort of circular thing. At the next level, a lot of founders don't understand the different kinds of capital that's available. And the biggest mistake that I see, people that need inventory so that they can sell to whoever, instead of getting inventory finance, they take equity dollars. And so now you have a business that's doing, I'm just making this up, but like $1 million in top line revenue that needs 500,000. And they're sort of saying, well, okay, maybe we'll give you a valuation of $1 million, maybe 500,000. Now you have a 50% partner and you just did your first inventory run, like talk about a mistake.
Mm.
So there's a lot of different forms of capital that's available out there. There's a lot of different things that you can do if you get creative enough. And it's just a question of, do you understand the capital markets enough so that you can kind of navigate them? And I think most founders don't. And it's like anything else, you just have to get educated on it. Don't be impressed by rich guys either. Rich guys are not capital sources.
Mm.
And most funds are out there raising money. Most funds are building their own businesses. Just because there's a fund that has X millions of dollars doesn't mean that you're going to even fit their profile. They have very strict investment requirements. So understand the capital stack, understand the returns that people need, start getting creative with that. Start building, okay, can I get my inventory funded here? Can I get a PO finance here? Can I get this? Can I get this? Oh my gosh, my equity gap, which I thought was here, is actually here. Cool. And then you go to the equity partner and you say, hey, I need much less equity than what I originally thought. I got X hundreds of thousands of dollars or millions of dollars coming from these other sources. Are you okay with that? Or do you understand that I'm going to be paying them back before it gets to the equity people because they're preferred, blah, 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 blah. Just make communication. That's what it is.
Mm, mm, mm. Yeah, look, I mean, because we could pivot now and talk a bit about execution. But you're 100% right. It's communication with everything,
Yeah.
So it's one thing where you have strategy and governance as part of the equation. But it's in the execution where the real leadership reveals itself, right? So I want to pivot here and talk a bit about speed and readiness, which we touched on a little earlier,
Hmm.
because beauty is that one industry that tends to celebrate speed.
Hmm.
Fast launches, fast growth, but and we alluded to it earlier, speed without infrastructure can also create real problems. So,
Yeah.
Connor, when you evaluate companies today, how do you think about pace?
So I think that it's you want to see a quick pace and you want that tied to a budget and a forecast and the hockey stick can exist as long as we know that that's what we're doing. And you can marshal the resources to support that kind of growth as long as you're prepared to support that kind of growth. And if you're not ready for that or that's not part of the plan, then it's kind of important to not let that happen until it is part of the plan. And and one thing is that, I think governance and forecasts and board decisions that can happen quickly. When there's an opportunity and you can be opportunistic, you can say we have an incredible opportunity right now to triple our top line. We can do it by maintaining our margin. Here's how that works. Have the discussion, modify the forecast, modify the plan, get buy-in from all the appropriate people and move. Where I think companies tend to fall down is when there's an opportunity and there's sort of paralysis by analysis because they don't really understand what analysis is. And it's like, let's look at it. What's the fact pattern? Let's make a decision.
Mm-hmm.
And really, what the paralysis by analysis, I think, ultimately is we don't have the resources to really support this growth. So we're just going to kind of keep looking at it until hopefully something changes. And I think that the the trick to good growth is good analysis, understanding where the growth is and understanding what the opportunity actually is going to be in bottom line dollars. Because in our industry, there's so much opportunity to go after top line revenue. And you can get into any retail partner that's their job. They sell products, they have buyers. There's buyers in every, I mean, it's just that's the nature of the beast. So you can get in anywhere, but how you maintain it, how you support the trade marketing, how you really kind of are going to drive the sell through. That's what's most important. And that's where you have to kind of understand like this growth is fantastic, but are we just walking into a giant trap here by, you know, essentially allowing our retail partners to let us foot the bill on them having inventory that they can just send back? Or are we sort of looking at near-term web sales that we think are going to continue for the next 9 months when this product actually gets into the warehouse? So I think as long as you're like really looking at the opportunity and using the same methodology that you would use year in year out, you can that's the trick. Like growth, when it separates you from your methodology, now you're lost. Now you're like, we're just out here doing stuff. But if you're like, hey, let's adjust our forecast to take into account these new opportunities, let's put the rigor and the work into making sure that that follows into the plan. Let's make sure that the CEO understands what the new budgetary requirements are. Let's make sure our founder understands how this might shape the vision of the brand. I think that's it. It should just flow in sort of like the normal workflows. I think that that's important.
And I agree, obviously, with everything that you've just said. But the advice that I always give to anyone who comes to me and says to me, I don't know what I don't know, right? Is that there are a lot of conversations that need to happen from day one,
Right.
right? Along with everything that you know what I mean, that you were just talking about now, there's also, you know, your R&D partner, your CM partner, your suppliers. These are all partners, right? And these are all, if you don't have those components aligned from day one, that
Yeah.
can also, you can have you can put, all these great ideas into place, your infrastructure, all of these things. But if you don't really understand what that means, you can find yourself on the back end just sinking into a hole.
Yeah.
Because, if you're going to scale, right, and if we're thinking about pace, you have to understand what that means. And not just in terms of MOCRA, right, but in terms of formulation and testing requirements and all of these things that actually take time to
Yeah.
complete. You know what I mean? Because
Yeah.
if you're not having these conversations, right, where are we selling? But do we understand the markets we're selling into? Because it's one thing to say, and I'd see this all the time. They would come, clients would come to me and say to me, okay, well, we want to go globally. Okay, that doesn't make any sense.
Right.
Where do you want to go? Because you can't
Right.
just say globally, right? Because if you want to go to Asia, that's very, very different than going to Australia or
Hmm.
going to the UK. Because the regulatory requirements. And then here in the United States, are you selling? Where are you selling? Are you just selling in the Midwest, or do you intend selling in California too? Because
Yeah.
we need to have these conversations on day one with your formulator, you know what I mean?
Right.
And with your packaging partner, because all of these things will make a difference in how you set up your pace, right?
Yeah.
So I want to pivot here again and talk about something else in leadership that I see so often. And the word gets thrown around, that word culture.
Hmm.
But so often culture just lives in the mission statement. Right? It
Right.
doesn't actually live in the daily behavior of a company. And in reality, it's something you usually don't notice until it's completely out of whack. It's absolutely not working. And I mean, I've seen and I've been in situations where toxic dynamics, work dynamics within the company, things like, finger pointing, cliques forming,
Hmm.
people avoiding accountability completely. And I'm talking about even at a leadership level,
Hmm.
or just employees feeling like they don't have a safe place to raise concerns. All of those things just lead to a company becoming an employee revolving door, with
Well,
people leave, new people are hired, time is spent recruiting, interviewing, onboarding. The problem is the actual work that is supposed to be moving the company forward falls behind.
yeah.
And, that's the kind of environment to me that usually signals the maturity of the leadership structure because
Yeah.
the culture almost always flows from the top. So it's like great leaders, from at least from my experience, they recognize when something unhealthy is developing and they address it quickly, right? Let's nip it in the bud.
Hmm.
But the problem lies when leadership ignores it, or worse, they contribute to it. And that impacts, you feel that impact across the entire organization really quickly. So, Connor, from your perspective, from your point of view, what does a healthy culture look like day to day when a company is well run? And I don't mean from a slide version. I mean from an operational version.
Yeah. Well, I think that that's a really important thing to talk about because one thing, beauty, the beauty industry, especially founder-led brands, have worst culture. It's almost like, and I think it's because the you know the founders kind of become the royalty of their little kingdom. Whatever they do, they're justified in doing because they had the vision for the brand, and everyone else should be grateful for even having a job. Whatever the founders do can be, you know, if there's a mistake, it's blamed in the execution from the team. Um, typically founders before they take on capital have very little oversight. So they're punishing employees unfairly or calling people out for lack of performance when they didn't necessarily set them up for success. They're, these founders get bored and want to have lunch. So they have lunch with, oh, I like having lunch with so and so. Suddenly you have little cliques forming, and then so and so knows to be in the room with the founder at these key things. So here's a reality. A healthy company and a healthy culture has to be devoid of ego. Like, you need to make your work time, and your home time. And in these founded led beauty brands, or with an inexperienced management team, what happens is the brand becomes all encompassing for all the team members. There's an expectation that everyone will pick up their phone 24/7. There's sort of a, a almost sort of like an institutionalization of gossip, where it's like someone raises a complaint and then there's a staff meeting, like, oh, well, Susie complained about this. Well, I don't even understand why she would be complaining about that. She didn't do this, that, and the other. And you're like, oh my gosh, is this a work meet? Like, there's no HR.
Oh,
It's just
Connor, what a waste of
insanity.
time. What a waste of
Yeah.
time.
So what you have to do is, and this is a top-down thing, and this is a really hard pill for the founders to accept, but the founder's role is, yeah, the vision's great. It drives the business. That's your job. It doesn't mean you're infallible. If you see someone not performing, you better check yourself real quick and ask yourself, is this my inexperience or my perception? Am I putting something on them that isn't really happening? How did I fail that person that caused them to not perform? And I think it's really important that founders or the executive team adopt kind of a service first approach, so that the team members, if you see something going on with your team, blame yourself, because it's your fault that they're doing that. And if someone cannot kind of rise to the the task, don't make it a company wide situation. Take them aside and say, hey, look, I'm trying to support you as best I can. I need you to give me better direction on how to do that.
Mm-hmm.
And if they say, I don't really need it, and start, I mean, it's sort of typical HR stuff. Like, when someone's winning, give them their flowers. When someone's struggling, see what support they need. Put people on performance plans as needed. Give people bonuses as needed. But don't have the the typical founder-led beauty cycle of, I'm the infallible queen or king that runs this, almost using staff members as audience, because there's very entertaining founders in our space that I think like the audience and attention, and use their team as sort of that backstop, and that's just unacceptable. And
Yeah, or
so
they also know, Connor, that their team isn't really going to argue with them.
right,
They're being paid to be there. So, you know what I mean?
right,
They will affirm, affirm anything that comes out of the
right,
founder's mouth, because they don't want to lose their job,
right,
and that's not a good thing either. I think the other thing as well, is that you have to know how to choose your HR.
right,
Because if you don't have the right HR team or the right HR person, in that position, that can be massively problematic, because you're never going to find, there has to be, and I hate using this term, but I'm just going to use this term because it's the best one I can come up with at this point, a safe space
hmm,
for employees to feel like they can go and ask for help, or they can, they
yeah,
may not feel comfortable asking, what I mean, their boss or whoever it is, and they feel
yeah,
like there's got to be a place where they can say, I'm not comfortable with my boss because of XYZ, and that becomes, and it's not easy to find good HR. You know what I mean? You
right,
can find a lot of people in HR roles, and the other thing it's pet peeve is when the HR person is, I don't know, my sister-in-law. You know what I'm saying? Because
right,
we want to give her a job. So, oh, you could do HR.
right.
HR is a lot more complicated than just that.
It's
And I do
and
believe that HR can be either a part of the problem,
yeah,
um, you know, um, or it can be a part of
and
the
I think
solution.
that the one of the other things is that HR is a cost. and it's a cost that gets, in this day and age gets minimized. So what
Mm,
you have is oftentimes you have the office administrator that utilizes the HR paperwork in the payroll system as essentially the backstop to having payroll. So here's your employee handbook, here's this, here's this, here's this. My advice to any founders or CEOs or just anyone out there that's in this, read the handbook. Make sure that you know what it is that you're giving employees. Make sure that you are updating the handbook accordingly. And if you're not in a place where you have a head of HR, you're a relatively smaller brand, make sure that there's some designated person that can kind of be that HR facilitator in the office.
mm.
And
With the right
I
personality.
would
Yeah.
say too that the HR role is very much a double-edged sword
Mm.
because most of the awful HR violations are on the part of the founders that are, we have an event at XYZ retailer and I need you two to go over there. And guess what? It's a 16-hour shift and you're a salaried person. So no lunch break, no this, no that, no that. And then they come back and it's like, hey, I saw you put dinner on the corporate card and, it just can get real messy real fast. So the HR component is something that requires a lot of looking, and the founders need to walk away from the ego, walk away from sort of this idea that this is my audience or these are loyal. And the thing that you really need to make sure is if you're ever saying we're like a family at this
Oh
company,
God.
you have done something incredibly wrong.
Yeah, I
Like,
know. Listen, if you ever go in, this is for the audience. If you ever go into a job interview and the first thing that that person interviewing you says is, "We're like a family," you know what? Say no thanks.
yeah,
Turn around and walk out.
yeah,
Because no, you're not. That's your job. They're not
right.
your family. Your family
Yeah,
are
they're
your
not your family.
family.
Exactly. And what happens in the we're like a family here, that's cover for we have no real organization here.
And no
We are
boundaries.
asking people to wear a million different hats. We don't really set clear boundaries
Mm,
and
mm,
it it gets real sloppy real fast. And
mm.
I know I made that mistake as CEO. I ran, one of the mistakes I made was leaning too hard in the we are family category because it feels from a boss standpoint, it feels like you're getting a lot of buy-in from everybody. You're bought into the success of these people, and it sort of fills the gap of real management.
Mm.
And the real management looks like here's your job for the day, here's your job for the week, here's your job for the month. We'll talk in 2 days.
Yeah. The other
You know,
problem with the weird the family is it becomes too emotional.
right,
There's too much emotional attachment to that because
right,
now you're putting people in impossible positions because if you really are family, where's your loyalty?
right,
You should be answering the phone at 9 p.m. on a Saturday night because
right,
I'm calling you. You're
right,
family, you know?
right,
Yeah, no,
right.
it just opens doors to a whole lot of
Yeah,
issues. But
yeah.
as we discussed earlier, leadership expectations are evolving rapidly, right? And in beauty, the regulatory environment particularly is evolving at a pace that feels like, I don't know, daily, right? There's so many changes with Mocha in place right now. And I think that companies are facing a new level of regulatory accountability. So I want to just jump back into the Mocha and the regulation side here. And, one nuance that I think is important to explore is how beauty CEOs today don't just think about regulation, but actually deal with it. And we touched on it very slightly earlier, so I made a
Mhm.
note to bring this back up now.
Yeah.
But what I've seen over the years in many companies is that regulatory expertise is treated as something that sits entirely within the regulatory affairs function, right?
Mhm.
Almost as if it's totally separate from the CEO's responsibilities. And it may have been that way in the past, but today things have things have just changed. There've been way too many changes. And so what I've also observed over the years is that when leadership views regulation as somebody else's job, it can influence the decisions that they make. right? And ultimately the outcomes for the business, because regulatory requirements don't just live in documentation. They shape product development, they
Yep.
shape, ch chain supply, supply chain
Supply chain. Yeah.
decisions, timelines, risk tolerance, and of course, as we talked about earlier, how companies scale. So, Connor, from an investor's standpoint, how do you think MOCRA changes the expectations placed on CEOs?
Yeah, it's a massive change. So the sort of the perception of regulatory was that it was like I think of it as sort of like the dusty librarian in the back corner office somewhere that had like volumes and would look, oh, this is this regulation or that. And you're right, like historically it sort of lived in documents and then got dusted off or that were adopted by your supply chain or your contract manufacturer, whoever. So you had this like safety net. And I think now, because of MOCRA and because of other kind of regulatory changes, it's moved much to the forefront of the organization. And the real shift at the CEO level is it historically has been very reactive. These governmental bodies are going to decide to do this or that or whatever. And once that gets passed, then we'll change our formulation accordingly. And I think now you're seeing people be much more proactive, much more forward thinking, much more in tune with what the regulators are talking about before they go in, much more in tune with any potential legislation or kind of governmental concerns, and not just in the US, but on sort of a market by market basis. And I think that, like you said, you can't just sit there and say, we're going to go global. You have to say, okay, selling into Mecca in Australia is very different than selling into Luxasia in Southeast Asia. Going to Nika or Mintra in India is very different than going to Douglas in Germany. Going to Douglas in Germany is different than going to Douglas in Spain. Like there's there's enough regulatory hurdles that when you're looking at product development, when you're looking at sales and marketing, when you're looking at even label requirements and packaging requirements. So
Yep,
it's a
yep,
design
yep.
function. There's so many different things that you have to, as a CEO, you almost have to just have that be kind of a fundamental thing that you're adopting. So every day, every decision is kind of led by what do we think the regulators are going to do in these different markets and can we see the sort of common denominator so that we can be in every market in a cost effective way, having the right kind of formulation and efficacy in whatever it is that we're selling so that we actually can live up to, because there's so many different things on that scale balancing it, but the big difference is the CEO needs to be able to articulate it on an individual market basis, on a global basis, on a regional basis, and have that in line with the vision of the founder and the mandate from the board.
Mm,
So there's so many things there just that goes beyond compliance
mm,
that it the CEO needs to have someone designated like a compliance officer or sort of a regulatory affairs officer that can kind of be on that, but they need to be briefed every week
mm.
and they need to be pivoting their decision making based on those briefings.
Yeah.
And I think that there's a need to have a different cadence with a board to kind of talk through regulatory and supply chain issues because it's not a set it and forget it kind of situation. And
No, certainly not.
you can have the second half of a year require a whole different situation than the first half of the year, and you need to be ready to make those changes. And kind of like we talked about before with contract manufacturers, they can't spin this up overnight.
Mm,
You need to be in lockstep with everyone so that you can take advantage of market opportunities, so that you can pivot when regulatory requirements require it, and not lose too much ground. So that really is a massive role that the CEO needs to play in that. And
I,
talk about a communicator. Like if they can't, they need to be communicating with the regulatory team, their sales and marketing team, the graphics department, the manufacturer, everybody. And it's just I hope the regulatory environment gets easier to navigate, but I don't think it will.
No, I don't think it will. And, honestly, I believe that we're going to reach a point in the US where cosmetic regulation is just going to become almost like, OTC regulation. You know what I
Yeah.
mean? It's going to be on the same the same wave, right?
Yep.
Where it's gonna go from because the way it used to be was just look, I mean, it is still pretty much the Wild West out there.
Yep.
There's still too many people, with this attitude of, well, if we don't take shortcuts, we're not going to make any money, right? For as long as you're flying under the radar, yeah, you can try taking shortcuts, but you're not, it's not sustainable, right? It's not sustainable. So let's just pivot here and talk about our closing piece because I think it's really important. You know, I think we've had a great conversation on distinguishing what is a CEO versus what is a founder, right?
Mhm.
And hopefully have given founders a little bit more insight into that and maybe the confidence to say, you know what, it's okay. I don't need to be the CEO, right?
Right.
But before we close and before we end this conversation, for all of those founders listening today, you know, um, as an investor, if these founders want to be the type of leader that an investor trusts, someone capable of building a durable beauty company, what
Mhm.
advice would you give them?
I think that the key for a founder is self-awareness and an awareness of the company. It's so easy for a founder to fall into a trap of needing money when they're not at a stage where they need to deploy that money, thinking that they need to hire someone to make intros when really they just are looking at getting into retail. They the 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 common mistake that I see founders making is really wanting to move too early into taking on capital, move too early into hiring a team. Like a scrappy startup or scrappy founder can get an MVP made, can have meetings with retailers, can get their interest. And buyers at retailers love independent brands. They love talking to founders. They love people that are doing new things at market. There's so much shelf space available right now across every retailer as brands go out of business. Every major retailer is redoing their beauty sections, their beauty spaces. We know the opportunity. So the advice to founders is be self-aware. You have an idea, great. Go get the product. Go take some pictures. Call up the friend that's a photographer. Go talk to Nordstrom. Go talk to Ulta. Go talk to Sephora. Don't know anyone there? Find them. They're there. These are people that are getting paid every day to talk to brands. They are so nice. They're so generous with their time. They'll give you insight. Talk to a Sephora person. They'll say, you know what? I don't like this brand. Here's what we're doing in Sephora. They'll give you the year. They'll tell you what's going on, and it makes the conversations that much easier. You just go out and start talking to people. Once you've had some of those conversations and you say, you know what, we got kicked out of Sephora. Ulta wouldn't even pick up the phone. Nordstrom told us to come back later, but Von Mauer, the little chain, 13 stores, they like us, and I like the buyer there. They want to do something different. I think we can make something happen. That's when you pick up the phone and you start talking to capital. That's when you have your first real conversation with your contract manufacturer. Hey, what are the MOQs? This is what we're forecasting. We get 10,000. 10,000. No. 2,000. We need 2,000. How do we make 2,000 work? Can we buy 10,000 over time? Can we do this? Can we do that? Like the self-awareness that it takes to know where you really are in your business and the discipline to keep pushing forward is really what shows that you're a good leader. And if you want to be a good leader and an investable leader, it's being able to come to the table and say, okay, I talked to 20 great retailers. Here are the three that want to move on us. I talked to five contract manufacturers. Here are the two that have the best prices. Looking at the forecast that these retailers gave me and the prices that these manufacturers gave me, here are the different scenarios on year one, year two, and year three. Here's what the capital is that I need. Here's how the website is going to work. Here's what the team's ramp up is. Here's where I think we can cut costs using, fractional service providers to manage the website, to manage the books, to manage this, that, the other. All right, that's a business. You're there. You've proven it. The thing to avoid is don't be the founder that is just pitching an idea. If you're the founder that says, I have a great skincare solution, I have a great color cosmetic, here's my deck, there's nothing to invest in.
Mm.
You're just somebody with an idea. Where's the business?
Mm.
So that's a red flag, because it's like, if you can't even do the stuff that you don't need money to do, what are we, that's when you start worrying about execution. So I founders that are listening, you have so much power. You have so much vision. All of this stuff is hard, the most hard thing that you can do, but it's there. Go to Sephora, go to Ulta, go to Nordstrom tomorrow. Find them on LinkedIn. Start having those conversations. Get 1 million no's and 5 yeses and start building out. No one is expecting a financial model. Just build out. This is what I think the business might look like.
Mm.
Okay.
Mm.
It's a starting point.
Yeah, absolutely. You gotta start somewhere. Start, like you say, start building out.
No?
Um, and yeah, it's for the audience, in closing, one of the most interesting things about beauty is that it often appears to be a creative industry, and it is. But behind every successful brand is something far less visible: structure, discipline, and accountability. And ultimately, those things start with leadership. Founders bring ideas into the world, but CEOs build the systems that allow these ideas to survive and grow. And as Connor and I just discussed today, those two roles are not always the same. Starting a company requires vision. Running a company requires operational discipline, governance, and the ability to make difficult decisions as complexity increases. And in today's environment, particularly with evolving regulatory expectations and the realities that MOCRA has introduced, the responsibilities placed on leadership are only becoming more significant, because in the end, the CEO isn't just responsible for growth. They're responsible for structure, culture, and accountability that determine whether a company can scale successfully. So, Connor, thank you for sharing your time with us today. I know how busy you are, and thank you for sharing your invaluable perspectives. I truly hope that you'd be open to doing this with me again.
Absolutely. This was so much fun. Thanks for having me.
Absolutely. And for those watching and listening, as always, if you found this video valuable, please like it and subscribe and share it with everyone you know who you think would find these conversations useful. You can also follow me and Connor on LinkedIn, where we share more expert insights on the issues and answers that drive smarter beauty investment. I'm Melory Johnson. Thank you for watching and listening, and I will see you all next time.